Coming up, the Australian share market crumbles, down 3.5% over the last three sessions. We'll tell you why in a moment. Also, overnight, the Bank of England lifts interest rates more than expected, and we take a look at the direction for food prices. That's coming up. It's a daily 10-minute business and finance news wrap for this Friday, the 23rd of June 2023. Later, why the Australian share market had its worst 3 days in a row since March. But first, let's go to groceries, where UBS has tracked food prices across the two major supermarket chains and found for dairy, fruit and veg and meat, prices rose 7% year on year. Individually, dairy and spreads up 10% year on year, fruit and vegetables up 3% over the past 12 months, and meat prices up 9%. The thing is, those prices, they are stabilising. So, have we seen the worst of the price increases? For more, I spoke with UBS analyst Evan Karatzas.
Through the month of May, we've seen food and beverage price inflation across those categories that you mentioned was up about 7% relative to the month of May last year, so May 2022.
How's it likely to move forward, and what's driving those prices at the moment, and how does it compare? For example, is it getting worse? Is it stabilising? Is it moderating?
Yeah, no, good question. So what we're seeing is that the raw prices across the food and bev category should be relatively stable here. The actual, the percentage change relative to last year will still be quite elevated until around that sort of, October, November type period, because that's really when we started to see some of these, real sharp price increases come through last year. So in going forward for the next, little while, you should expect to see pretty stable, raw prices through those product categories. You'll sort of start to revert back to much smaller type price increases that we've seen for many years, the 2 to 3%, that low single digit type price increase, across those sort of the categories that I look at. But yeah, broadly, I would say it's relatively stable from here.
So is it fair to say that we have now seen the biggest price increases coming through for those kind of foods that you're looking at? Why, and what initially drove it then?
Yeah, I would say so. The big driver of it has been it's been a few things. The raw inputs to a lot of our food and beverage products, think of your meats and your chicken, for example. What we feed our chicken, the wheat and the soy, we saw really sharp increases there. Dairy prices, the price that the farmer receives, we saw real sharp increases there. So it's really just these raw inputs to all our products. That's been the big drivers of some of the price inflation. And yeah, as I said, I would expect it to be relatively stable from here.
Do you think the message for consumers is that even though prices have come up and they might stabilise from now on, they should be used to these elevated prices? It's not necessarily that these prices are now going to come down.
Yeah, it's a fair question. That's sort of the big unknown. I would assume, just given the wage and labour price environment, you think utility costs, lease costs or rent costs for some of these food producers. I would say, the current prices are something that you'd expect going forward as well.
That is Evan Karatzas there from UBS.
Now, Market Day on the SBS On The Money podcast.
Well, the Australian share market ended the week on a bum note. The S&P ASX 200 down 1.3%, 7,099. Tech and mining stocks leading the declines, and it comes as the Bank of England lifted interest rates more than expected. It caps off a horrid back end of the week where shares on the 200 declined 3.5% over the last three trading sessions. For more, I spoke with Morgan's Raymond Chan. Raymond, let's start with the Bank of England, lifting interest rates there by a bigger than expected 50 basis points to 5%. That's a 15-year high, and it could go even higher. Is there a shift in global central banks moving interest rates even higher than first thought?
This is a very good question because I think the global central bank has been pretty consistent. They are data dependent. They look at the data on month-to-month basis, and so far we do not hear any central bankers say they have reached a peak of interest rate high cycle. However, on the other side, which is the market expectation and the consensus. And the consensus has been underestimating this rate high cycle. A good example is, back home in Australia, the consensus were thinking about RBA to peak around 4% just a few months ago. And now they all have to adjust expectation to at least 4.8%. I think similar experience is happening to UK at the moment, where, yes, we have seen some evidence of inflation being easing. However, it's still not concrete enough to see, the inflation will stay down for long. So we are likely to see all the central bank, of course, apart from a few such as, China, most of the central bank will have to have the interest rate higher for longer.
Yeah, you mentioned China. We'll talk about it in detail in a few moments. But given that we are seeing higher interest rates for longer, is there a threat that it will trigger a global recession, and how significant is that?
I think globally, the economy is fairly fragile. Of course, it mostly recover from COVID, and they mostly benefit from the reopening. However, with the synchronized interest rate rise, there's always risk of recession. However, we don't usually worry too much about the recession. Sometimes a recession may not be a bad thing. If we just experience what we call a mild recession, then it's actually a good thing, because that is likely to hold off a lot of people spending intention, as well as control the inflation. What, of course, we do not want to see is hard landing, where the economic growth cool down significantly, and especially in a short period of time, that create a lot of shock to people. But so far, we are seeing soft landing as a distinct possibility, especially in US. I think a soft landing will certainly address a lot of high inflationary pressure that we are seeing at the moment.
The move overnight, though, did trigger a fall in terms of the oil price, down 4%. Gold is at a 3-month low. Markets are looking a bit shaky. Can you run us through the fallout?
Well, we actually quite positive about oil at the current level. Remember, there's always a lot of moving parts with oil. We have, the China outlook. We have, the international travel demand. We have the demand and supply side of the oil. And of significance, of course, early in the month, we have the OPEC plus meeting, where the biggest OPEC member, Saudi Arabia, they actually announced cutting the oil's production by 1 million per day. That, I think, is significant. And also this cut won't happen until July. And if we purely just look at, the Saudi full output capacity is around 12 million. If they do cut additional 1 million as they stated early in the month, they actually reduce the production to 9 million. Remember, 1 to 2 million within a day is between a bull market and a bear market, for oil. So I think, when this cut happened, the oil price should, certainly see a floor. And, we think the oil is quite cheap at the moment. On the flip side, the gold, if we look at the gold price, it has gone through a significant bear market since early 80s. But interesting, if we look at the past 5 years, the gold is on the bull market. What happening at the moment is the gold price challenged the $2,000 per ounce, and they meet the resistance. So until the gold hit a breach above this $2,000 psychological barrier, the gold price will still be looking around like that. But if we look at 6 months, it's probably not looking that good. However, if we look at 5 years, the gold chart is actually looking pretty good.
Okay, let's go into detail into one area that you know a lot about, and that's China. It's been one of the big stories of the week. Continued economic stimulus being pumped into the country. A number of key interest rates have been cut numerous times over the past 2 weeks. What's your take on the Chinese economic environment and its post COVID opening? Because when the economy did reopen after this prolonged closure, they were pretty optimistic. It did rebound, but then all of a sudden, not much growth.
Yeah, absolutely spot on. When I talk to my contact in China, people tend to ask me not to look at the year-on-year figures because obviously last year whole thing lockdown. So on a 1 year basis, of course, it's all double-digit return. They tend to look at the month to month. As you mentioned, initially we have this reopening projection, from the beginning of the year, people, really optimistic about the China opening. And then, 1 month after another, they saw the figures getting worse and worse. And it come to a point where the May figures coming out is certainly send a worrying trend for the market. So the script has changed, the tone has changed, before May, people talking about, whether China should stimulate. Now the script has all changed to how to stimulate. A lot of concern, regarding the unemployment. Of course, the unemployment rate on the headline number looks respectable, 5.2% only. However, there's a lot of youth unemployment happening at the moment. So the figures I got is 20.8%. So almost 1/5 of the youngsters in China unable to find a job. So that creates a lot of social problem where, the government will likely to address in coming weeks.
Okay, finally, for investors out there, what's this all likely to mean for the investment environment, and are there any opportunities at all?
Sure. I think the first thing we have to look at is there will be important government meetings in July. We call it the China Politburo meetings. This is when the top leaders sit down and talk about some policy. Of course, we already start to see a bit of interest rate movement from the PBOC, but so far we have not seen the movement in required reserve ratio. The last movement was back in March. I think that's likely to see more discount, more movement come from there. And in terms of investor, if China do come up with a stimulus, of course it is unlikely to be the massive infrastructure scale, that type of stimulus that we have seen 10 years ago. However, there's still likely to be some infrastructure investment to be promoted. So our big miners are likely to be benefit. Another area I think may benefit will be the area of electric car. For Australia, we're quite fortunate. We are one of the biggest producer of lithium in the world. So the lithium area, despite the strong performance today, that likely to continue to got support. Last but not least, of course, for those who can invest overseas, they can also look at the China A market. Why do I talk about A market, not the H market? A market predominantly listed for those companies listed in China. They are more consumer-driven stocks. The biggest name Chinese company, consumer company are listed in A market rather than the H market in Hong Kong. So I may see a divergence of performance from A to the H market for those who investor who look at overseas investment.
That is Raymond Chan there, the head of Asian Market Desk at Morgans.
This SBS On The Money stream is provided for informational purposes only. The content in this stream should not be understood as constituting advice or a recommendation. It is not personal advice and it does not consider your personal circumstances or objectives. You should contact a licensed professional before making any financial decision.